Hello, everyone, and welcome back to Synaptic Investing. Hope you're having a fantastic week and are ready for another deep dive.
Absolutely. Good to be here.
Today, we're breaking down one of the most requested companies in the comments, Evolution AB, often just called EVO.
Ah, yes. EVO, a fascinating one.
It really is. On the surface, we see research pointing to, well, frankly, world-class financials, almost a monopoly position in its niche. But the stock, it's trading like there's an imminent disaster looming.
Exactly.
So the real question for us, the central question today is, why this massive disconnect? What's the fear the market sees that seems to contradict the fundamental quality? That's what we're here to find out.
That's a massive question. And before we really get into the weeds on that, just a quick note for everyone watching or listening.
Yeah, definitely. For those of you who want to act on investing ideas like this, having a professional-grade platform is, well, it's key. We personally use Interactive Brokers, and we've actually partnered with them to get our viewers a stock bonus when they sign up using our link.
So you get a bonus, support the channel, win-win. That link is right down there in the description, correct?
That's right. It's in the description below. And of course, if you find value in this kind of in-depth discussion, like really digging into a company, the best way to let us know, and honestly, to make sure you get the next one, is to hit subscribe and like the video.
It genuinely helps the channel reach more people. And please, if you have questions as we go or thoughts on EVO, get involved in the comments section. We do read them.
We absolutely do. Okay, perfect. Now let's get into it. Pillar number 1, the business model.
Okay, so right off the bat, the crucial thing to understand, as you hinted, is that EVO is not a consumer-facing casino. They don't take your bets.
Right, they're behind the scenes.
Exactly. Think of them as the B2B infrastructure provider, the picks and shovels for the entire online gambling world. They provide the tech, the dealers, the studios.
For the big names we recognize, like DraftKings or William Hill.
Precisely. They license out their live casino solutions, think live blackjack, roulette, with a real dealer streamed to your device.
Okay, so this toll road model everyone talks about, how do they actually make money from that licensing? What's the mechanism?
It's actually quite elegant, and this is key. Their main revenue stream is a commission fee. This isn't a flat fee. It's a percentage of the operator's gross gaming revenue, or GGR.
GGR being just the total amount the casino wins from players on EVO's games.
Exactly. The operator's winnings. So EVO essentially gets a royalty on the success of the games they provide. There's also a secondary stream from fixed fees, like if an operator wants a dedicated table with their own branding, but the commission is the main engine.
Okay, wait, that sounds incredibly powerful. It's not like typical software as a service where you pay a fixed subscription. This scales directly with the entire industry's gambling volume, or at least the volume going through their games.
That's the beauty of it. It's a royalty on the gross profits of a rapidly growing industry.
But doesn't that tie them too closely to the operators? Like, aren't they exposed to the crazy marketing wars the DraftKings of the world have to fight, or sudden regulatory changes hitting one operator?
You'd think so, but it actually provides a kind of insulation. EVO themselves spend very little on player acquisition that's the operator's problem and cost, and the regulatory risk. It's diversified across hundreds of operators in dozens of jurisdictions.
Ah, okay. So if one country cracks down or one operator messes up, it's a hit, but not existential because they're spread so wide. As long as overall online gambling grows, their commission pool grows.
Pretty much. They ride the wave without getting caught in every single breaker, so to speak.
Okay, that makes the model sound very smart, very resilient. But how defensible is it? What stops a competitor coming along offering a slightly lower commission rate and stealing market share?
Right, that's the crucial question. And the answer lies in the moat. It's not just one thing. It's what Charlie Munger called a Lollapalooza effect. Multiple factors combining and reinforcing each other.
A composite moat. Okay, break that down. What are the main pillars holding it up? I'm guessing regulation is a big one.
Huge. Absolutely critical. First, you have intangible assets. EVO has built this reputation as the gold standard in live casino. The quality, the user experience, it's seen as top tier.
Players prefer it.
Players demand it. But even more important is the regulatory maze. Getting and maintaining gaming licenses in all the key places, Malta, the UK, New Jersey, Pennsylvania, Michigan, and so on. It's incredibly complex, expensive, and takes years. It's a massive barrier to entry.
So just the cost and headache of compliance keeps potential rivals out.
It's a major filter, yeah. Then that combines with the scale-based network effects. This is maybe the strongest part.
How does that work in this context?
It's a virtuous cycle. Because EVO has the best games and the licenses, players want to play them. Because players demand them, operators have to offer them. They become like mission-critical content.
Can't run a competitive online casino without EVO games.
Increasingly, yes. This demand gives EVO enormous scale. We're talking, what, over 1,700 live tables globally now?
Wow. And the competition.
The nearest rivals, like Playtech or Pragmatic Play, might have around 100 tables each, maybe a bit more. It's an order of magnitude difference.
And that massive scale means?
It means they generate huge cash flows, which they pour back into R&D, into innovating new games, better technology, hiring the best dealers. It fuels the quality advantage, which attracts more players, which forces more operators. You see the cycle.
Okay, I see the reinforcement. So let's test this moat. You mentioned Playtech. Didn't they try to attack EVO directly? How did that play out? Did EVO have to cut its prices, its commission rates?
That's the fascinating part, the pricing power paradox. Playtech did try. Their main strategy was to undercut EVO on price, offer operators a lower commission percentage.
Seems logical. Cheaper option, operators switch, right?
So it largely failed, because operators aren't just looking at the percentage rate, they're looking at the total profit generated. And what they found was EVO's games, even with a higher commission rate, generated significantly better GGR performance.
Hold on. So operators actually made more absolute money paying EVO's higher fee because EVO's games were just that much better at attracting and retaining players and generating winnings.
Exactly. The player preference and quality trumped the lower price point. The moat isn't built on being the cheapest. It's built on being the best, the one that maximizes the operator's bottom line.
That is serious pricing power. It demonstrates the value they provide is indispensable. So where does that leave the competitive landscape now?
It's basically an oligopoly, but with EVO as the clear dominant leader. Estimates put their market share around 45%, maybe even higher in live casinos specifically. They're just operating on a completely different level.
Okay, if the moat is that strong, the financials should scream quality. Let's look at the numbers. What does the quantitative fingerprint of this business look like?
Yeah. The numbers are, frankly, exceptional. It's the kind of stuff you usually only see in textbooks. Profitability, for instance, EBIT margins have consistently been above 65%.
65%. That's software-level margins, but in a business with studios and dealers.
It's world-class. Now, there's been some recent slight compression, maybe down to like 66% more recently, but that seems tied to understandable things, launching new studios, which has upfront costs, some regulatory ring fencing in the EU, temporarily impacting certain markets, but still, maintaining margins in the mid-60s is just phenomenal.
And what about efficiency? High margins are great, but not if you have to constantly pour capital back into the business just to stand still. How good are they generating returns on the money they invest?
That's where the ROIC, return on invested capital, comes in. And again, it's exceptionally high, often exceeding 100%.
Over 100% ROIC.
Yeah. It confirms the moat, but also that the business model is incredibly capital light once the studios are up and running. The tech scales, the game format scale. This leads to really high free cash flow conversion, too. The cash just pours out.
Okay, high margins, incredible efficiency. What about the balance sheet? You hear about sin stocks facing regulatory risk, fines. How prepared are they for a storm?
This might be their ultimate strategic weapon. They operate with zero net debt. In fact, they have a huge net cash pile. Last I checked, it was over $650 million.
So tons of cash, no debt.
Exactly. In an industry that's always under scrutiny, always facing potential headwinds or sudden regulatory costs, having that kind of financial fortress provides just incredible resilience. They can absorb shocks. They can keep investing in growth. They can weather pretty much anything financially.
That kind of discipline usually starts at the top. What about management? Are they aligned with shareholders? Is there significant skin in the game?
Oh, massively. Total insider ownership, including the founders, is huge. It's around 35% of the company.
Wow, over a third.
Yeah. So management's interests are fundamentally aligned with long-term shareholders. They win when the stock price goes up over the long haul, not by playing short-term games. The CEO consistently talks with a very pragmatic long-term view.
And does that show up in how they allocate capital? We see the huge cash generation, the fortress balance sheet. What do they do with the excess cash?
They have a very clear, rational framework. Priority one is organic growth, investing in new games, new studios, new tech. Then they pay a dividend. After that, maybe some small strategic M&A, if it makes sense. And then this is key. 100% of any remaining excess cash is returned to shareholders via share repurchases.
Buybacks, and they've been doing that recently, right? despite the stock price being down.
Yes, significantly. They announced a large EUR 500 million repurchase program not long ago.
Yeah.
That's management basically shouting from the rooftops that they believe their own stock is fundamentally undervalued at current prices. They're buying aggressively.
Okay. So we've painted this picture: dominant B2B toll road, incredible composite moat, stellar financials, fortress balance sheet, aligned management buying back stock, which brings us right back to the core mystery. Why the disconnect? Why is it trading at, what, 10 or 11 times earnings?
Exactly. Now we have to confront the risks, the fears, the perceptions that are clearly weighing heavily on the stock.
Where do we start? What's the market seeing, or maybe misseeing?
I think a major source of confusion is the dual customer sentiment. You have to separate how players feel from how the real customers, the operators, feel.
Explain that.
If you go look at forums, Reddit, wherever players gather online, the sentiment towards any gambling product, including EVO's games, can be overwhelmingly negative. You see accusations of games being rigged, people talking about losses, addiction. It's often linked to pain and frustration.
That creates a constant reputational headache, a sort of background radiation of negativity around the stock.
For sure. Permanent reputational risk.
Yeah.
But if you talk to the B2B operators, their perspective is completely different. They see EVO as an essential, indispensable partner, the provider of mission-critical content that drives their own revenue.
So the market sometimes struggles to separate the B2C product perception from the B2B business reality.
I think that's a huge part of it. They see gambling and
Yeah.
all the associated negativity and apply it directly to EVO stock, maybe without fully appreciating the B2B royalty model insulation.
Okay, that's an external perception issue. Are there any internal red flags? Things within the company itself that could be a genuine threat?
Well, this is something that does give pause. If you look at employer reviews, say on Glassdoor or similar sites, they're quite polarized. Lots of positives, but also a recurring theme in the negatives about the work environment.
Like what specifically?
Things like toxic management, terrible work-life balance, mentions of an inner circle culture, the kind of stuff that can really impact morale.
That's not just an HR issue, is it, in a business like this?
No, it's a direct threat to the moat. Their competitive advantage is their people. The innovative IT staff, the game designers, the highly trained professional dealers in the studios. That's their largest cost center, yes, but it's also the engine of quality and innovation.
So if morale drops, if key people leave because the culture is bad, that could erode the product quality that the whole moat is based on. We even saw some operational impact from that strike in Georgia, didn't we? It caused capacity issues.
Exactly. It's a real risk factor that shouldn't be dismissed. It directly impacts their ability to execute and maintain that quality edge.
Okay, so we have reputational risk, potential internal culture risk. Now let's quantify the valuation disconnect itself. You said 10-11x PE. What was it historically?
Historically, EVO often traded at a PE closer to 29x, sometimes even higher, which, makes sense for a business compounding earnings at such high rates with such high quality.
So from nearly 30 times earnings down to roughly 10-11 times, EV/EBITDA is also down significantly, around 7.5x now.
Yeah, around that level. The market is essentially pricing this company not as a high-growth, high-quality compounder, but more like a low-growth, high-risk utility company facing serious threats.
And that valuation gap represents the opportunity if you believe the market's fears are overblown. But what is the single biggest, most legitimate fear, the one that could justify such a low multiple?
It has to be the gray market cliff. This is the #1 permanent risk hanging over the stock.
Explain that. What are gray markets in this context?
These are jurisdictions where online gambling isn't explicitly legal and regulated, but it's not strictly prohibited either. It exists in a legal, gray area. A significant chunk of EVO's revenue, although they don't disclose the exact percentage, comes from these markets, particularly in Asia.
And the risk is a sudden crackdown.
Exactly. A coordinated global regulatory action, or even action by a few major gray market countries, could shut down that revenue stream almost overnight. If a large portion of their current revenue vanishes before the newer regulated markets like North America become big enough to offset it, that's the cliff scenario. That could permanently impair the business.
Okay, that sounds like a genuine, potentially catastrophic risk. So the investment case hinges on assessing how likely that is, and whether the current price already discounts it may be too much.
Precisely. It's about distinguishing between transient noise and permanent impairment. The market seems to panic sell on every negative headline. The Georgia strike you mentioned, reports of minor game piracy, the temporary effects of EU ring-fencing rules.
These feel like manageable short-term issues for a company of EVO's scale and financial strength.
Mostly, yes. And what gets ignored in the panic is that some of the biggest potential regulatory risks have actually been resolved or de-risked recently. Things like the dismissal of that securities class action lawsuit in the U.S., or the closure of the investigation by the New Jersey Division of Gaming Enforcement. Those were potentially huge threats that have now faded.
But the fear lingers, and the multiple stays compressed.
Fear seems to trump the facts, for now. That's where the margin of safety potentially comes in buying, when the fear is arguably peaking and disconnected from the slowly improving reality, especially regarding the major known regulatory threats.
Okay, let's really stress test this. Let's invert the thesis, as Munger would say. Assume the market is right and the 11x PE is not an opportunity but a value trap. What has to happen for us to lose money here, for this to be a disastrous investment? What's the path to ruin?
The path to ruin, the real nightmare scenario, is a convergence of the worst fears. It requires two things to happen almost simultaneously. First, the gray market cliff does happen, and it's catastrophic. Let's say 40% or more of their current revenue disappears suddenly due to regulatory crackdowns.
Okay, massive revenue hit.
And at the same time, the growth engine everyone is counting on, North America, stalls out. Maybe widespread political opposition to online gambling expansion slams the brakes on new state legalizations, or regulators get incredibly restrictive. If you get that double whammy massive current revenue loss plus future growth evaporating, then yes, the stock probably re-rates permanently lower, and the current price was indeed a trap.
That combination seems possible, but maybe not probable. Assessing those odds is the key task.
That's the entire game here, balancing the known quality against the known and unknown risks.
So wrapping this up for you, the listener, what we've laid out is a business, EVO, that fundamentally looks like a wonderful B2B operation. It's got this powerful toll road model protected by multiple reinforcing moats, regulatory scale, quality. Financially, it's a fortress.
World-class numbers, huge cash pile, no debt.
Right. And yet it's trading cheaply. Why? Because of fear. Fear driven by headlines, by the negative perception of the B2C product, gambling itself, and crucially by the very real risk of a gray market crackdown, even if other risks seem to be fading. The market is confusing the product with the business model.
And the path out of this low valuation, the single biggest catalyst that bulls are focused on, is the continued opening up and growth of the regulated North American market, both the U.S. states and Canada. That's the vast, largely untapped holy grail that has the potential to re-accelerate growth significantly and force the market to reevaluate the company's quality.
Okay, before we go, I want to leave you with a final provocative thought that kind of ties this all together. Think about those reports, allegations really, of the Black Cube smear campaign a few years back. The story goes that a major rival, widely suspected to be Playtech, allegedly hired investigators to essentially fabricate negative reports about EVO, trying to trigger regulatory problems for them.
A pretty desperate move, if true.
Exactly. So ask yourself this. What does it tell you about the fundamental strength and competitive position of a company when its biggest rival apparently feels the only way to compete is not through better products, not through lower prices, but through resorting to alleged smear tactics? What is that competitor's panic signal about the quality of the fortress they're trying and failing to breach?
It suggests the moat is real, and the competition knows they likely can't win on a level playing field. Often, the actions of competitors tell you more about a company's strength than its own financials. Something to think about.
Definitely something to mull over. That's all the time we have for this deep dive on evolution. Thanks so much for joining us.
Thanks, everyone.
We'll see you next time.